Hi, Professor Barati here. Just want to go over Chapter 5 homework with you quickly. In particular, the transfer pricing. Because transfer pricing is rather confusing and it's not heavily, basically not heavily questioned on the CPA or CMA exam. So let's go through these problems fairly quick without getting you hung up, because the budget problems are far more time consuming. So in this problem 8, the transit company, which price would Seattle Transfer prefer? The price is the highest price, $5.10 per trip. Which price would the state prefer? It's the lowest price, which is 0 reimbursement. And if transit provides an average of 161,000 trips, what is the monthly value of the difference between the prices and full capacity? To solve that problem, just simply take the full price, full cost at $5.10 minus the 61 cents, and you'll get $4.49. So just take the difference between the full cost and the fare collected on your problem, multiply it by 161,000 trips, and you'll get your answer. The next problem is Transatlantic Metals has 2 operating divisions. Its forging operation in Finland, which is one division, and then it ships to the U.S., which is another division, the gear division, which uses the metals to produce finished gears. Operating expenses amount to $20.1 million in Finland, which is what you want to put here as a third-party cost, and $60.1 million in the U.S. If the metal were purchased from one of the company's U.S. forging division, the cost would be $30.1 million, which is the transfer cost. So the transfer would be a transfer cost to the U.S., but revenues to Finland, because Finland is selling to the U.S. as a transfer price. It cost Finland $20.1 million in the problem. In the problem, it says that the sales are 151 million U.S. So the U.S. can turn around and take that transferred good and sell it for 151,000. In addition, the add-on cost to sell that 151 million is 60.1, so that's your third-party cost. The transfer cost is 30.1 million, but it is revenue to Finland. So simply do the math here. Your taxable income is 10 million, 60.8 million. The tax rates are given to you in your problem. Take your tax rate for Finland and apply it, and your tax rate for the U.S. and apply it. The second part is what happens if the Finnish supplier, if there's a purchase from an independent supplier, the cost would be 40 million. So analyze the tax liability jurisdiction by using the alternate transfer price. So in here, again, Finland revenues would be 40 million, but to transfer to U.S., that would be a transfer good cost. The 60 million third-party cost still holds up, and 151 million holds up. The only thing that really changes, okay, is going to be the 30.1 million becomes 40.1 million. Taxable income changes. Again, apply the tax liability to get your tax liability answer. Straightforward. The next problem is just simply a transfer price problem between operations and financing operations. Operations had 44 million in sales last year. So in your problem, you want to record the $44 million as outside sales revenue for operations. Costs other than those charged by the finance division total $22 million. So your outside costs under operations are $22 million. Financing division earned revenues of $13 million. So outside revenues are $13 million from servicing loans and incurred outside costs of $14 million. Financing charged operations $12 million in loan-related related fees. So here's your transfer pricing issue. The finance department charged operations $12 million. So they're going to record $12 million in the sales section for total revenue. Operations is going to charge themselves that same $12 million as a cost. Operations manager complained to Larry that financing was charging twice the commercial rate for loan-related fees, and operations would be better off sending its buyers an outside lender. What are the reported segment operating profits for each division? So here you go. Just plopping in the simple numbers, you get 10 for the operations and 11 for financing. What are the reported segment operating profits for each division, ignoring income taxes and using a $6 million commercial rate as the transfer price? Just simply take the above using the $12 million and change it to 6. So instead of charging $12 million, the finance division recognizes $6 million as a price, and the operating division recognizes $6 million as a cost. And then just calculate the operating profit. That's all you need to do. Let's look at budgeting problem number 2. Midland Company buys tiles and prints different designs on them. It buys the tiles from a small company in Europe, so at all times it keeps on hand a stock equal to the tiles needed for 3 months' sales. Tiles cost $1 and each and must be paid in cash. The company has 29,000 tiles in stock. Sales estimates, which are right here, based on contracts received, are as follows. Estimate purchases in units, cash required to make purchases for January, February, March. This problem basically is an inventory T account approach. So what I would do is basically for January, our beginning inventory we are told in the problem is 29,000. We don't know what the purchases are. That's what we have to figure out. But we do know what January sales in units are, 11,800. And we do know what inventory is at the end. They tell us that we need 3 months of inventory at the end of each month. So we need 3 months of sales. So we're going to take 17 from February, March, and April sales and add them up. $17,700, $13,500, and $14,200. $13,500 and $14,200. So, ending plus purchases will equal ending plus the sales minus the beginning. And just to make sure, 29,000 plus 28,200 minus 11,800 equals 45,400. So our purchases for January will be 28,200, and the cost at $1 per unit equals 1 times purchases of units. Now on to February. Same approach. So for all February, the beginning inventory now becomes our ending inventory, right? Because now new month, that becomes beginning. Purchases are known, less sales, which will equal, for the months, 17.7. Ending inventory is going to be 3 months. So for February, we're going to take 13.5, 14.2, and 9,100, 3 months ahead. March, April, May. Purchases, we'll just copy this formula over, will be 9,100. At $1 equals the same 9,100. For March, same approach. Beginning inventory becomes, ending inventory becomes beginning inventory. Purchases unknown. The sales for March are 13.5. And ending inventory is the 3 months, so it's 14.2, 9,100, and 7,800. 3 months forward, April, May, June. Purchases will be 7,800. At $1 is 7,800. And there's your schedule. And that's how you approach second prop question on Middling Company. So hopefully this gets you through the homework a little faster, and I appreciate you watching. Thanks.